Let's face it, guys, when it comes to investing in the stock market, it can be a very stressful endeavor, mainly because there's so many different options, right? Just think of the number of companies that are on the stock market, the different types of bonds, mutual funds, index funds, like so many different things that you can invest in. So if you're planning on investing in individual stocks, you might find it difficult to really have time to analyze all the financial reports, track all of the different trends, determine the right time to buy and the right time to sell. And if you have a full-time job, this can be borderline stressful. But if you still do want to participate in the stock market, but you do it in a more passive way, ETFs can be a really good option for you. So in today's video, I'm going to be revealing the 3 ETFs that I believe any investor should consider having in their long-term portfolio. So first of all, what the F is an ETF? Well, think of an ETF as like a basket of stocks or bonds. So instead of you investing in the individual companies, you're investing in a group of them. And some of these ETFs have as many as 500 companies in their particular portfolio. What this means is that you instantly get diversification, which helps reduce your risk. Because think about it, you're not just investing in one company, you're investing in a lot of companies. So your stock portfolio is not really tied to one company, but it's tied to all these different companies that are in your portfolio. So the first ETF that we're going to review is VOO. And VOO is Vanguard's S&P 500 ETF. So it basically tracks all the S&P 500 companies and then variety of sectors from technology to healthcare, consumer goods, financial services. So it's pretty diverse. And it was launched over 14 years ago in 2010. And it has a very low expense ratio. In fact, this is one of the big appeals for VOO. At 0.03% expense ratio, it's pretty the lowest that you can get with regards to expense ratio. So let's dive in and take a look a little bit deeper into VOO. So as you can see, the VOO closed at $532 on October 25th. And what I like about VOO is that it is a really good, solid player with regards to return. So like the year-to-date return so far, and when October, it's 23%. And the category average is 19%. So it's actually performing above average. If you look into the one-year return, it's actually 40%. And the category average is 32%. And then the three-year return is about 10%. And the category average is about 10% as well. So it's performing on average, but as you can see, the year-to-date and the one-year return, it's really outperforming. Now, if we come and take a look at some of their holdings over here, you can see that a lot of the top 10 players are literally in the tech space, right? You have Apple being number 1, Microsoft number 2, Nvidia number 3, Amazon number 4, and Meta number 5. So, they have the usual suspect as part of their portfolio. But you also have Warren Buffett's Berkshire Hathaway commanding a top 10 position, as well as, Eli Lilly, and this is a pharmaceutical company that's also within the top 10. Now, when it comes to sectors, right, like I had mentioned earlier that they're in various sectors, you can see that they're in technology, financial services, healthcare, communication, energy, like they're pretty spread out, although technology commands 32% of their portfolio. A really good ETF, but at 532, it's a little bit expensive. Well, platforms like Robinhood allow you to buy partial shares. So if your budget is, let's say, $100 per month, you can then just buy $100 worth of the share of the ETF every single month and slowly build your position. So VOO, very good option for you to invest. You saw it's highly diversified. And now let's move on to the second one. The second one is also another Vanguard ETF, and this is the VGT, which is Vanguard's Information Technology ETF. So if you're really bullish on the tech sector and you believe that the future is really around tech and innovation, this is your ETF. And VGT, like I mentioned, it's solely focused on tech. So it has companies like Apple, Microsoft, Nvidia. And now the one thing about VGT is that it's been one of the top performing ETFs in the market. However, by being focused on the tech sector, it means that you also expose yourself to higher risk. So that's why VGT It offers higher return, but it also exposes you to a little bit of risk. Hey guys, I just wanted to let you know that every 2 weeks I have a bi-weekly boot camp where I teach people how to trade. So if you're looking to become a better trader, or if you've never traded before and you're looking to learn how to trade, you should definitely consider joining my trading mastery bootcamp. And I do it every 2 weeks, and it's a 2-hour session, and it's really a good way for you to just get an intro, a 101 of sorts into trading. So the details are in the description, and I hope to see you there. So let's dive into VGT and just go through its numbers, and you can see what I'm talking about. VGT closed at 601, well, 602 basically, on October 25th. And then if you look into their performance, the year-to-date performance so far is 25%, category average is 15%, 1-year return is 49%, whereas the category average is 34%, and then the 3-year average is almost 13%, whereas the category average is only at 3. So you can clearly see that VGT is definitely outperforming the category. Now, when we look into their holdings, remember VGT is it's only tech, right? So their largest position is Apple at 16%, Nvidia at 14%, and then Microsoft. And then they have other players like Salesforce, Adobe, Broadcom, Oracle, and so forth and so forth within their portfolio. And one thing about VGT is that it has over 300 companies in its portfolio, whereas VOO has over 500. And remember, VOO is spread across multiple sectors, and VGT is specific to tech. So hence why they have less companies in their portfolio. But the long and short here for VGT is that focus on the tech sector, has a slightly higher expense ratio, but it's delivering really good return. And this could be a really good option for you if you're looking at, being more aggressive with your investing strategy. So VGT is an option that you can have in your portfolio if you're looking for that aggressive growth. The third one that I'm going to be talking about is the Schwab Dividend ETF, SCHD. Now, this ETF focuses on companies that consistently pay dividends, which means if you're an investor who's looking for more stable income growth, that's not too aggressive, that's consistent, this would be yours. And SCHD, it usually invests in companies that are well established, like Coca-Cola, Pfizer, Pepsi, and companies that regularly dividend payouts. We're going to dive into the numbers. Now, the first thing you can see about SCHD is that it's way cheaper than the other two at $28. Yes, you heard me right. $28. Now, the cool thing about this ETF is that its expense ratio is 0.06. Remember, VGT was 0.10 and VOO was the lowest at 0.03. SCHD is in the middle at 0.06, but it's very, very affordable at $28. Now, if we look into its performance, year to date, it's delivered 14%. The category is about 16%, so it's performing a little bit below average. 1-year return is 27.92%, whereas the category is 27.14%, so it's slightly performing above average. And then the 3-year return, you can see that it's 6%, but the category average is 9.58%. So when it comes to return, the numbers are not as strong. It's performed decently in its portfolio, right? Consistent dividend paying companies. So this is one way. If you just want consistent, steady income, this would be your choice. They have about 100 companies in their portfolio. And if we take a look into their main holdings, you'll be surprised with some of the companies they have. Their largest position is the Home Depot, right? You look at VOO and VGT, their highest holdings are tech companies. The second highest holding for SCHD is Verizon. And then you have BlackRock and Coca-Cola, Chevron, Pfizer, and some of the other companies within the top 10. So you can definitely see that there's not a lot of heavy mix with regards to tech companies. They're looking to invest in companies that are consistent in their dividend payouts, that have a really good, solid business and solid track record. If you're kind of like looking for the slow and steady type of growth, this would be the stock you want to focus on. The question now becomes, which one should I pick? Well, in my opinion, if budget allows, I think you should actually invest in all three, because what that does is you get to benefit from all of the advantages of all of these three ETFs. So for example, if you have a part of your portfolio in VGT, you get to benefit from the explosive aggressive growth that the tech sector is experiencing. If you have SCHD, you get to benefit from the slow and steady dividend income that will come out of it. And if you're in VOO, you have a much diverse group of companies that you get to benefit from. And again, is the S&P 500 usually performs really well, so you get to benefit from that. But if you had to pick one, I think the decision will now need to be based on three things. Number one, what are your goals? What are you trying to achieve, right? Number two, what's the time horizon? If you're younger, you might be attracted to the VGTs of the world because you can be very, very aggressive when you're young, and you can really grow your portfolio fast when you're young. But if you're kind of like in your twilight years, you're getting ready to retire, you might want things that are a little bit, steadier and more predictable. So, and then the third thing is the budget, right? We saw that SHED is relatively way more affordable than VOO and VGT. So for example, if you only have $500, you're better off buying 20 shares of the Schwab dividend ETF because you can only buy a partial position on VOO or VGT, right? So these are just some of the considerations that I would have if I was someone looking to invest.